It's been said that this pandemic for credit will be similar to what demonetization was for payments. I just wanted to know your views in terms of whether do you agree with that statement and how do you see the pandemic changing the lending?
I would just like to add that currently what's happened is that, you know, what demonetization, what not was to payments, what UPI was to payments essentially, is what is happening today because of pandemic. It has really accelerated the whole, digitization focus for even the larger banks, which earlier thought it was, you know, difficult to move in that direction because they have, archaic systems, they have large systems, they have lines across various products, and they would, think 20 times before disrupting anything. But it's kind of forced upon each one of the lenders that people have to digitize. Like Adil mentioned, it was a boon that certain things happened. For example, the video KYC bit, the offline Adhar KYC bit, which is gone there last year. So these things really enabled the ecosystem. So it is true that large and small banks, alike, large and small lenders alike, everyone has been forced to get into the accelerated mode of digitization. And I think we've covered almost 2 years worth of digitization effort in the last 6 months.
So, can
Yeah,
you give us some examples, like what are the big changes that you have brought in post COVID to fast pace the process of digitization? So, what are the maybe you can highlight some of the big changes that has been done after that?
Yeah, Anshul
yeah.
and Jasmeet both spoke about the fact that the rails were there, right? And so we were already in the process of digitizing the whole journey. And luckily for us, you know, uh, the whole personal loans piece, the digital SME piece, all of that has been a focus area. And I agree with Anshul that, some of the things when it comes to, let's say, housing, when it comes to auto loan, because there is dependence upon external agencies, there's dependence upon central repositories, which are yet to be digitized, and therefore those processes are not digitized fully. But for us, the last leg of, meeting the customer for KYC and for, fulfillment, that was the only leg which was really left for us to digitize as a lender. We were always, onboarding digitally. We were always underwriting digitally. So I think that's the leg where we as a lender have focused upon, and this pandemic has provided us the time and, time, focus, and energy to kind of accelerate that. And we that's been a shot in the arm, I would say.
But you know, we have had mixed reports. So on one hand, we've had bankers telling us that uh, things will pick up around the festival, and at the same time, we have these global rating agencies uh, talking about Indian banking system will be the last one to recover from the pandemic. So in our mind, it's too extreme, and maybe because we do see reports which talks about, let's say, two-wheeler sales will pick up, or HDFC is witnessing transactions or inquiries which were pre-COVID level for housing loans. Uh, Without, I mean, being specific to anything, just wanted to understand that if we are talking about these two extremes, what sense do we make of it? If any one of you could take that question.
See, I think, if I may, so I think what's happening today is there are two parts to the whole piece. One is the origination, and in origination, we are about, say, 60% of where we were on pre-COVID time, right? Like I mentioned earlier, while our inquiry levels, I'm saying across the industry, is hovering around 75% now, the throughput obviously has decreased. So even with 75% of the pre-COVID inquiries, we are getting about 40-50% of the business right now, which will possibly pick up further. Of course, it depends upon the kind of product that you're talking about. If you talk of, a personal loan, a credit card, this is more, uh, discretionary spend driven. So possibly that will still see some kind of normalization in the eyes of the, customer. But when it comes to housing, two-wheeler, auto, and we already see auto and two-wheeler is almost 90% of pre-COVID levels in terms of their
Right.
throughput as well as the, inquiries. So the second part, and which is what possibly the rating agencies are calling out, is the overall portfolio quality. And I think it is very, very important for all of us as bankers to tread very, very carefully, cautiously with restructuring, with whatever tools are there available, so that we ensure that the portfolio doesn't go out of hand. Because portfolio going out of hand could really mean a big dent. And the MSMEs and the corporate sector NPAs obviously create a larger dent. Retail at the end of the day is not the determinant of what the stress a bank will face. So larger banks with larger exposure to the corporate side will have to be all the more cautious about it, because there the pickup will be lagging behind the retail pickup. So retail pickup over the next 60 days, then that will result into some corporate pickup, and therefore there's a longer timeline for them. I also think that for personal loans specifically, since that's something that we are seeing, it's moving in multiples. For example, when we restarted our business after the lockdown period, uh, we struggled to get the first 10% in, but the next 20% and the next 30% after that has happened in a matter of 30 days. So I think obviously it will taper off. My sense is that we should see retail demand go up to about 70-75% of pre-COVID level during this festive season. And only possibly by next March is when we see the volume kind of fully recovering to pre-COVID levels.
How do lenders look at restructuring of loans? When when a borrower opts for a restructuring of loan, so how does lender look at it? So are they considered as defaulters? So like as per the RBI guidelines, they will be reported as restructured loans to the credit bureau. So what will be the impact of the same on the credit score of the borrowers?
When it came to, I'm just going a step back, when it came to moratorium, right? So moratorium was essentially a tool in the hands of a consumer where he or she thought that he or she may not be able to pay and therefore will like to opt for moratorium. Now, there were also a set of people who definitely had the capability to pay, whose incomes really did not get impacted, but they were maybe a little risk averse, or they thought in the forthcoming months, or in the latter part of the year or latter part of the pandemic, what if I lose my job? What if I lose my income? And they also, they were fence sitters, so they also opted for moratorium. So when lenders started evolving these customers, for credit underwriting, they kind of thought, okay, the ones who have taken moratorium, we should avoid them. Subsequently, lenders realized that a lot of people took moratorium as fence sitters, and hence whoever had restarted paying, they started looking at these people favorably. But restructuring is very different. Now, restructuring is after the period of unknown. Pandemic was a very, last 6 months have been an unknown. We didn't know how things will evolve, how businesses will unlock, how markets will open, how the demand will shape up. So all of that was unknown. Now it's a lot more is known, right? We know in some shape and form we will continue to do business. We know that today all of us sitting here are talking about 70-80% of business returning in the festive period, so on and so forth. We also know what this whole virus is about broadly, how to live with it, so coexist with it. Keeping all these things in mind, after that, people who have had permanent damage, where they are unable to pay back their obligations, pay back their EMIs, they would, from a banking system perspective, be looked at a little adversely for some period of time. Maybe, like we used to earlier say, a person having settled a card, we would wait for that person to have a new relationship, a credit relationship, and if that person has repaid well, you kind of start believing that whatever happened in the past was temporary. Same thing will happen with restructuring. It will take some time post restructuring of loans to look at those customers again favorably. Maybe secured loans will still take a call on that because you have a collateral and stuff. But on unsecured side, I guess restructured customers will be kind of avoided for some time.